My name is Tom Mims, and I will be presenting our final deliverable for Bank of America. Bank of America is one of the largest financial institutions in the U.S., managing assets in value of about $2 trillion. Bank of America generates the majority of their earnings through consumer banking, global wealth and investments, global banking, and global markets. Some of the services Bank of America provides to their customers are checking, credit cards, home loans, small businesses, and investments. Over the next 7 slides, I will go over the general environment segments that could affect Bank of America's performance. The economic segment. The majority of the banking industries have a major concern over China's economic instability. Between the years of 2009 and 2014, China's debt to GDP growth has increased to over 75%, which is a clear indicator that there could be a financial system problem within China's economy. The social cultural segment. And according to the North Center for Public Affairs Research, Americans' confidence in banks and financial institutions has declined by half over the past 40 years. Many of the key issues driving this lack of confidence derives from the 2008 financial crisis, saving and loan scandals, and also due to the fact that many four of the largest banks are currently in the U.S. They believe, many investors and shareholders believe, that banks may be too big and should be broken up. The global segment. During 2015, Bank of America saw a 4% plunge in revenue from fixed income, currencies, and commodities. During the second quarter of FY16, an additional 15% decline. Bank of America received an additional 15% decline in revenue from its trading department. Also, Bank of America cut 10,000 jobs in FY15 to save additional costs. The technological segment. Due to the increased advancement of technology, fewer Americans are actually visiting bank branches and utilizing more online or mobile apps to execute their banking transactions. Bank of America, in 2015, Bank of America had about 17.6 million active customers using its mobile platform. Additionally, Bank of America continues to experience a shift in consumer behavior away from branches and toward more self-service from their consumers or their customers. Political and legal segment. Bank of America spent about $3 million lobbying to Congress, whereas the largest bank, JP Morgan, spent over $8 million in 2013 lobbying to Congress. And the second largest, Wells Fargo, spent about $6.8 million lobbying to Congress. One factor that's a major focus for lobbying to Congress is the ease of regulations on derivative investments. The demographic segment. Due to the steady decline in the number of young workers supporting retirees, currently about 5.2 workers as of now support retirees, whereas there's a forecasted 3 workers that will be supporting the retired workforce by 2030. Therefore, banks continue to alter their investment strategies as the older generation draw down pensions much slower. Also, banks are also changing their investment transactions and financial advisor fee structures to migrate from transaction to fee-based. The physical segment. Bank of America has an impressive corporate social responsibility program. Bank of America has implemented a $10 billion catalytic finance initiative to accelerate clean energy investments in emerging economies. Also, Bank of America has provided nearly $40 billion in financing for low carbon activities and more than $60 billion in community lending and investing. Next, we'll go over the 5 forces analysis. All right, we'll begin the 5 forces analysis with the bargaining power of buyers. Many of the bank's differentiators are generally concentrated in 3 general areas, which are quality, technology, and the cost of a product and/or service. However, the consumer has a low buyer power decision of banking selections. All right, so typically, banks generally do not have a large range of suppliers. They're considered more of a vendor than more of a vendor providing a service than anything. So therefore, some of the bank's main supplier of capital would be depositors, various markets which provide credit, and the Federal Reserve Bank. As for threats of new entrants, so in today's societies, banks are facing a bigger threat as far as new entrants like tech companies. And the reason why these tech companies are a threat to banks is because tech companies have more cash on hand than banks. Tech companies have fewer regulations than banks. And also customers nowadays with the increased social media and online companies, customers have a stronger bond with tech companies like Amazon or Google. Likewise, these tech companies have developed ways to improve electronic payments in the banking industry. And these products have become key to providing convenience to customers. And as customers begin to use these products more frequently, tech companies are continuously looking for ways to be more innovative and reduce the use of cash. Interfirm rivalry. All right, so interfirm rivalry has been within the banking industry for hundreds of years. Some of the factors or some of the competitive strategies that these banks use to lure clients away from each other are by offering lower financing, preferred rates, and investment services, amongst other factors. All right, the competitor analysis. So for Bank of America, between January of 2013 to March of 2016, Bank of America's aggregate stock price ranged between $10 a share to about $19 a share, whereas its competitors, Citigroup, J.P. Morgan, and Wells Fargo, nearly double or even triple that stock price. So as you see, Bank of America has a lot of growing to do in comparison to its competitors. Okay, over the next 4 slides, I'll be going over the financial performance and liquidity ratios for Bank of America and its competitors. So for Bank of America, the return on equity in 2013 was 5%. In 2014, dropped to 2%, but in 2015 they rebounded to 6%. For their return on assets in 2013, it was at 5.44. In 2014, they dropped to 2.29 and then rebounded again in 2015 to 7.43. Now, their debt to asset ratio, this piece is critical. In 2013, they had a 0.89 debt to asset ratio. In 2014, they had a 0.88, and in 2015, they remained stagnant at 0.88, which means that Bank of America has about 89 cent of debt for each $1 of equity. For JP Morgan, in 2013, their return on equity was 8%. They increased in 2014 to 9% and increased again in 2015 to 10%. Their return on assets in 2013 was 7.39. In 2014, they increased to 8.46, and in 2015, they increased again to 10.36. Now, their debt to asset ratio in 2013 was 0.91. In 2014, it was 0.91 again, and in 2015, they reduced to 0.89. Which means that in 2015 they had about a 0.89, about 89 cent of debt to each $1 of equity. Wells Fargo. So in 2013, Wells Fargo return on equity was about 13%. In 2014, it was about 13%, and in 2015 they reduced the percent to 12%. As for their return on assets, in 2013 they were at 14.39. In 2014 they reduced to 13.64, and in 2015 they reduced again to 12.79. And their debt to asset ratio in 2013 was kind of high; it was 1.45. However, in 2014 they reduced that to 0.89. And in 2015, they reduced it even further to 0.75. So, which means that Wells Fargo in 2015 had about 75 cents of debt for each $1 of equity. Citigroup. So, for Citigroup in 2013, their return on equity was about 7%. In 2014, they declined, or they reduced down to 3%. And in 2015, they increased back up to 8%. As for their return on assets, in 2013, it was at 7.27. They reduced down to 3.97 in 2014, and in 2015, they increased again to 9.97. Now, their debt to asset ratio was in 2013 was 0.89. They remained stagnant in 2014 to 0.89, and then they reduced in 2015 by 2 points to 0.87, which means that Citigroup has about 87 cents of debt for each $1 of equity. Now, to go over the performance analysis of all competitors across the board, it was fairly close at approximately about 0.89 or 89 cents of debt for each $1 of equity. Now, this is an acceptable industry standard within the banking industry. As long as you stay below that threshold of 1.5 or lower, it's considered acceptable. If you're above 2, then that's considered unacceptable. So across the board, all competitors were fairly close. However, Wells Fargo has considerably outperformed the other competitors in 2015 by producing a debt to asset ratio of 0.75 or 75 cents in 2015. Merger and acquisition. Between the years of 1983 to 2008, Bank of America had about 9 merger acquisition activities. The most notable acquisition was the Merrill Lynch acquisition in 2008 for $50 billion. But within 3 months of Bank of America acquiring Merrill Lynch, Merrill Lynch's value plummeted to about $15 billion in loss, resulting in Bank of America reaching out to the government for support from the Treasury Department and the FDIC, and they received about $24 billion in support from the government and FDIC. From the Treasury Department and the FDIC. Okay, Bank of America's product line performance. As I stated earlier, Bank of America generates the majority of their earnings through consumer banking, global wealth and investment management, and global markets. So in 2015, Bank of America net income for consumer banking was about $1.8 billion. And also in 2015, their net income for global banking was about $1.4 billion. And they also had about a $614 million net income for the global wealth and investment management. And lastly, they had about $185 million of net income within the global markets in 2015. Okay, some of Bank of America's key resources and capabilities. Bank of America has the ability to borrow at low short-term interest rates and reinvest the money in higher yielding instruments, such as various types of loans or government securities. Additionally, they have some deposits that are non-interest bearing, and technically almost 40% of the deposits are domestic deposits. And also, they only have to pay about 0.08% interest on the interest-bearing deposits. Okay, some of the key problem areas. Bank of America is continuously facing competitive pressures from other companies looking to gain entrance into the market. Two of the most dangerous competitors facing the banks are technology companies, as I stated earlier, and the financial tech companies. Now, of course, we already know the technology companies, they have more cash on hand than banks, and they do not have the same, they have less regulations than banks. However, the fintech companies are also trying to take a slice of the market as well from the banks. So, in a survey taken by the Economist Intelligence Unit in 2015, many bankers understood the importance of going digital in order to remain competitive in the new age of banking. In an assessment, 49 bankers thought that it was very important for banks to implement a clear and strategic vision for digital banking. And although fintech companies are pretty much taking the lead on digital banking, the question is, will banks hop on for this ride, or will they continue to perform in traditional ways? Okay, recommendations. One recommendation that we decided to present is for Bank of America to become or to be more competitive is to create a digital program that will appeal to customers and compete in the digital banking service. Now, Bank of America has already has already done so, or started to do so, by implementing an instant payment program to compete with fintech companies. And this instant payment program allows customers to instantaneously transfer money from one account to another customer's account via a mobile device. So, for an example, if two of you were out, if two of you were going to split lunch, you could send money instantaneously over to the other guy's account or female's account via just a mobile device without going through the bank. All right, recommendation number 2. Bank of America should implement a loyalty program which encompasses some great incentives in order to appeal to customers and let them know how much Bank of America appreciates their business. Due to the fact that fintech companies focus on offering individual services, financial services, that's an option Bank of America could do as well. They could reevaluate the possibility of rebundling financial services and adding incentives to these services to appeal to the customers. And recommendation number 3, we feel Bank of America should refocus or redefine their focus on customer service, which will increase their customer acquisition and retention. In 2015, J.D. Power conducted a survey on small business banking satisfaction, and Bank of America scored last in 3 out of 4 of the regions in the U.S. And in the 4th region, that was the Midwest region, they scored in the median percentile. So there's definitely an immediate need for Bank of America to redefine their customer service focus and maybe implement a voice of the customer in order to enhance their customer acquisition and retention. Okay, this concludes my presentation for our final deliverable for Bank of America. Thanks for listening.